So far, we've learned a little bit about the market and how it behaves. You might be starting to get excited about investing in the stock market. You might also want to know which company to buy or where to invest your money to get the best return. But those aren't the right questions we need to answer, not just now. That may sound strange. How do I get the best return? Sure seems like the right question, doesn't it? Why is deciding which company to buy or where to invest the wrong question? It's not so much that those are the wrong questions, it's more that they only represent about a third of the investment decision. And frankly, it's the third that you least control. In this lecture, we're going to learn what determines how much money you make over the life of your investment, whatever kind of investment that may be. Stephen Hawking, the brilliant British physicist and author of the popular book on cosmology, A Brief History of Time, says that every equation in a book reduces the readership by half. He simply had to include one, though, E equals mc squared. That may have cost Hawking half of his potential readers, but he simply couldn't discuss the structure of the universe without Einstein's famous equation. We're in the same position. We simply can't discuss investing without the formula for compounding earnings. I promise, though, this is the only equation we're going to use in all of these lessons. Are you ready? Here it is. The terminal value equals the investment times the quantity of 1 plus the rate of return raised to the power of the time invested. The arithmetic required to use this formula isn't that difficult, and any calculator built into just about any smartphone can handle it. This equation says that the terminal value of your investment, or how much you have when all is said and done, is equal to the amount that you invest multiplied by 1 plus the rate of your return you earn raised to a certain power. That power is the number of time periods that you stay invested. For example, if you invest $100 at 5% annually for 1 year, then the number of dollars you'll have equals 100 times 1.05 raised to the first power. That's $105. I'll be doing some numerical examples in a few minutes, but the point of those examples isn't going to be the formula or even the specific numbers. No, the point will be the way that the inputs to this little formula affect how much money you'll have at the end of the day. Let's lay the groundwork for that before we get to the numerical examples. This little formula teaches us a lot. First, it tells us that 3 things determine how much you'll eventually have after you make your investment. Yes, one of these 3 is indeed the rate of return you earn. The higher the rate of return you earn, the larger the terminal value, the more you'll have when all is said and done. But that's only one of the 3 things that determine your investment. The other 2 are the amount that you invest and how long you're invested. The more you invest, the more you'll have. That makes sense. The longer you invest, the more money you'll have, at least as long as your rate of return is positive. That makes sense too. Second, the formula tells us that investing is a lot like planting a tree. The best time to do it is 15 years ago. But the second best time is today. If we had planted a tree 15 years ago, then we could have enjoyed its shade or hung a swing from it today. But if we didn't plant it 15 years ago, then the best thing we can do now is plant one today. Same with investing. If we had started investing 15 years ago, then we'd have a nice little nest egg by now. But if we didn't start investing 15 years ago, then the best thing we can do is start investing today. I promised to do some numerical examples to illustrate how the 3 inputs to the formula, the investment, the return, and the time horizon, affect your terminal value. Let's do those now. First, we'll do what all investors want to do. We'll increase our rate of return and see what happens. Suppose that we're really smart, or maybe just really lucky, and we triple our rate of return from the previous example, from 5% to 15%. That's a big jump, From the formula, we'd see that 100 times 1.15 raised to the first power is 115. That $15 we earned is 3 times as much as we'd have earned at 5%. Let's give ourselves a big round of applause. After a year, we made a whole $10 more than we would have if we hadn't been really smart or really lucky. That extra $10 didn't sound nearly as impressive as tripling our rate of return, did it? We just learned an important lesson. For small investments and short investment horizons, the rate of return really doesn't matter very much in terms of the dollars that end up in our pocket. Realizing that the rate of return really doesn't matter very much for small investments and short investment horizons is an important lesson. Most people don't start investing by putting large sums of money to work right off the bat. High rates of return almost always involve high risk, and it doesn't make sense to take a lot of risk to chase a big return on a small amount. People who start out chasing returns usually find out that they can't sleep as well as they'd like. If you're like most people, then you're much more likely to put relatively small amounts to work initially. Before you chase big returns, think about how many dollars you're actually expecting to make. Instead of seeing what happens when we take risks to chase returns, let's see what happens if we double the amount of our investment to $200. Plugging the numbers into the formula, we get $210. We can also get the answer to this one if we just think about having 2 separate investments. We have our original investment of $100 that grew to $105 after 1 year at 5%, remember? Instead of thinking of a new $200 investment, we can think of a second investment, one that's identical to the original first one. The first $100 grew to $105, so the second identical investment of $100 at 5% for 1 year would also grow to $105. Those $205 outcomes total the same $210 we got when we used the formula directly. This example illustrates 2 points. First, we've learned that the more you invest, the more you'll have at the end of the investment, at least with a positive rate of return. That's so simple that lots of people don't bother acting on the message. Among the easiest ways to be sure you'll have more money later is to invest more now. The second point is that investments are additive. If you double your investment and keep everything else the same, then you'll double the money you'll have later. If you cut it in half, then you'll only have half as much. That makes sense. Remember it when you're investing. Whatever good you can do by investing, you'll double it if you can double your investment. Some of you might wonder what happens if you invest a more substantial amount. Let's say that after paying the bills and setting aside an emergency fund, you have $10,000 to invest. Say you decide to roll the dice and choose a higher risk investment that will pay off 15% over the next year, if things go well. Even with a pretty big investment, the lesson of short investment horizons and relatively small amounts comes into play. Even if things do go well and you do earn that 15%, you're only going to have earned $1,500 at the end of the year. You'll have made maybe $500 over a safer investment. Hey, I'm not going to scoff at an extra $500, but let's be realistic. That extra $500 isn't going to let you hobnob with the rich and famous. The question you need to ask yourself before you invest in that risky investment is whether or not it's worth the risk. Is the chance of hitting a home run on an investment over a short period of time worth it? Now let's see what happens when we vary the investment horizon. We've seen that at a rate of return of 5%, $100 turns into $105 in 1 year. Let's make this investment for 10 years instead of 1. From the formula, we'd see that 100 times 1.05 raised to the 10th power is $162.89. What happens if we let that investment ride for another 10 years, for a total of 20 years? What will we have if we let it ride for a total of 30 years? It turns out that after 20 years, our $100 investment has grown to $265.33. That's a total return of over 165%. After 30 years, it's grown to $432.19 for a total return of over 332%. We're starting to look like investment geniuses. Suppose that instead of investing $100, we invest 100 times that, or $10,000. How much would we have at the end of 30 years at 5% annually? That's easy. The answer is $43,219. How do I know? One way is to stick $10,000 into the formula and crank out the answer. Another way is to remember that investments are additive and just think of $10,000 as 100 stacks of $100. Each of those $100 investments produces $432.19, so we should have 100 piles of $432.19 when we're done. That would equal the same answer I got from the formula, $43,219. We're not investment geniuses, of course. We didn't do anything sexy like take a lot of risks or pick a winner. We just stayed in the game for a long time and let compounding work for us. No, we're not investment geniuses, but I won't tell if you won't. Time can work wonders for investments. The Canarsie tribe allegedly sold Manhattan Island to a Dutch trader named Peter Minuit in 1626. The estimated sales price is usually given as $24. My grade school teacher was trying to show that the tribe got the bad end of the deal. Was it really a bad deal for the Canarsie tribe? Let's assume that the reported numbers are correct and suppose that the Canarsies invested that $24 at 6%. 100 years later, by 1726, they would have had $8,143. Wait another 100 years, and in 1826, the value is just over $2,763,000. By 1926, it's $937.5 million. And by 2026, 400 years after the sale, the tribe would have almost $320 billion. Put that way, the deal that the Canarsies negotiated doesn't sound so bad. 400 years is a long time, and the power of compounding really comes into play. The deal that Canarsie negotiated sounds even better when you learn that the tribe probably didn't even live on Manhattan and probably didn't own the land they sold in the first place. But that's another story. We've been asking questions that boil down to, how much will I have if I invest a certain amount and earn a certain rate of return over a certain period? Let's turn the problem on its head. Let's ask this. Suppose that I need a certain amount of money. How do the rate of return, the initial investment, and the investment horizon work to reach that target value? Think of that dream vacation you've always wanted. Pretty pricey, isn't it? Maybe nightmarish is a better term than dream. You're almost ready to give up. There's no way you'll ever have the extra $10,000 you need. You may be right, but before you give up your dream, let's see if we can find a way to make it happen. Let's nail down two of the variables in the formula and see what the third one has to be to reach the target value. We'll do time first. The first thing we need to know is, how long can you defer gratification? Since the alternative is never enjoying this vacation at all, you might be willing to wait quite a while for your dream to come true. Let's say 15 years. The next thing we need to know now is, how much can you invest right now? I'm sure that the answer is nowhere near enough. But let's say that you could do without this year's vacation and put $2,000 toward your dream vacation. Plugging those values into the formula, we get 2,000 times some unknown return raised to the 15th power. You can solve this any number of ways, including by just plugging in guesses for the return until the result is the $10,000 target value. The answer turns out to be just over 11.3% annually. Maybe you can find an investment that ought to return that much, and maybe you can't. Now, though, you're in a much better position to take whatever action you need to make your dream come true, whether that's giving up the whole thing as a bad job, or whether it's skipping your vacation this year because you're saving to make a lifetime dream come true. Instead of nailing down the time and the size of the investment, let's nail down the rate of return in the investment. What happens? Say you can only earn 9% instead of 11.3%, but you have $2,500 to set aside now instead of just $2,000. How long will you have to let this investment ride before you have your $10,000? The formula tells us that an investment of $2,500 times 1.09 raised to some unknown power equals $10,000. Turns out you'll have to wait just over 16 years to take your dream vacation in this case. The larger investment almost, but not quite, offsets the lower return you expect to earn in this case. Now let's say that your dream vacation has to occur at a certain time. Maybe you're an astronomy buff and want to be at a particular place on a particular date and time to view a solar eclipse. That eclipse is 12.5 years from now, and you can only earn 6.5%. How much do you have to pony up now to make it happen? Don't let the fraction and decimal points scare you. Your calculator will be just as happy to solve this one as it is for round numbers. The formula says that some unknown investment multiplied by 1.065 raised to the power of 12.5 equals $10,000. I don't think you're going to like the answer to this one, though. After all, we already know from the previous two examples that rates of return well above 6.5% and investments of $2,000 or even $2,500 would leave you short of your goal in 12.5 years. Hate to break it to you, but how does an investment now of $4,551.24 sound? Of course, you might want to make repeated payments instead of just one initial payment. That would be what's called an annuity. You may have heard the word annuity used to describe an investment that converts an initial outflow into a series of payments you receive over time. Here, it's that concept turned inside out. A series of outflows builds to a terminal value you receive at the end. The formula for computing annuity values is more complicated than the one we've been using, but the idea is the same and the results look much the same too. I promised that I'd only use one formula and I'll stick to that, so I won't give you the annuity formula here. You can find it on the internet if you like. In fact, there are lots of tutorials on the internet if you're interested in the underlying calculations. We won't take the time to go into that. You just need to know that the key points of annuities and single investments are the same. The same three variables affect the terminal value: the size of the investments, the rate of the return, and the time horizon. The biggest difference between an annuity with its multiple payments and a single investment is that the terminal value builds much more rapidly with an annuity. That makes sense because making more investments as time goes on puts more money to work for you. Let's see how making annual payments affects the way you save for that dream vacation. We still need to nail down two of the variables in the formula. We'll do time and investment. I've already decided that you can defer gratification for 15 years. But instead of asking, how much can you invest right now, we'll ask, how much can you invest every year starting now? Let's say it's $250. If you can invest $250 every year and need $10,000 for a dream vacation in 15 years, then it turns out that you need to earn just over 11.5% annually, which isn't far from the 11.3% we got with the one-time investment of $2,000. To me, the smaller annual payments seem much easier to handle. $250 per year sounds much less intimidating than investing $2,000 now. At a rate of around 11.3 or 11.5%, you can reach your goal of $10,000 in 15 years, either by making a one-time investment of $2,000 now, or by making 15 annual payments of $250 starting now. There's no free lunch, though. The total number of dollars you need to invest to hit your goal is bigger if you make a series of smaller investments, because you don't have much money working for you during the early part of the investment horizon. Here, those 15 annual payments of $250 total $3,750. That's $1,750 more than if you could come up with the necessary funds to make that one-time investment. Next, instead of nailing down time and investment, let's nail down the rate of return in the investment. As with the case with the single payment we did earlier, say you can earn 9%. You can still only put $250 aside each year starting now, so it's going to take more than 15 years it would take at about 11.5%. How long would it take? The answer is between 17 and 18 years. That's 2 or 3 years more than it'd take at 11.5%. If you can only defer your dream vacation for 15 years, then the formula says you have only two options. You can invest more, or you can earn more on what you do invest. If you had seen this coming, then you could have changed the third input into the formula, the time horizon, but it's too late for that. The best time to start saving for your vacation was 17 or 18 years ago. Too late, go with the second best option. Start now. The Roman Lucius Cornelius Sulla, who died in 78 BC, is credited with his own epitaph, which reads, "No better friend, no worse enemy." Historians tend to think he was referring to himself, and they're probably right, but finance guys think Sulla was thinking about time. When it comes to investing, you have no better friend than time and no worse enemy. Make time your friend. Let's plan for that solar eclipse you want to see. Remember, the eclipse is 12 and a half years from now, and you know that you can't expect to earn 11.5%. 6.5% is more realistic. How large do the annual payments have to be so that you'll have $10,000 in 12 and a half years? 12 $500 payments starting now and earning 6.5% will do the job if you let the total investment earn interest for the last 6 months. To me, that sounds a lot more palatable than a single investment of $4,551.24 now. The trade-off, of course, is that those 12 $500 payments total $6,000, or almost $1,500 more than if you could come up with the necessary funds now to make that one-time investment. There's no free lunch. Let's summarize. First, 3 things determine how much you'll have at the end of your investment period. Those 3 are the size of your investment, the rate of return you earn, and the time horizon. The bigger the investment, the more you'll have. The higher the rate of return, the more you'll have. And the longer the time horizon, the more you'll have as long as you earn something. Second, most people try to increase the factor that's the hardest to affect. That's the rate of return. Experts agree that it's hard to find investments that have the chance to pay off a lot without taking a lot of risk, too. Third, even if you do find an investment that promises a high rate of return, it doesn't mean much if you only invest a small amount of money or if the high returns don't last very long. The Street has a saying, if you're early, you don't have to be smart. The general technique we've been using to calculate the values of investments is part of a more general set of tools that finance professionals use, called the time value of money. For example, did you know that companies use the same concepts we've been using when they decide whether to build a new factory? It's true. Big companies planning investments worry about the same 3 things we worry about: how much money they invest at the beginning, how much they earn as a rate of return, and how much money they receive either along the way or at the end. Think of it this way. We've been figuring out what happens if we invest money now so that we get a certain amount of money later. That's really the same thing as deciding to build a factory. The company decides to invest money in the factory now in anticipation of the factory producing products that'll be worth a certain amount of money later. The company can use the beginning value and the ending value to calculate the rate of return on the factory. Do you have a mortgage on your house? That's another example of the concepts we're using. The mortgage lender loans you enough money up front to let you buy the house in exchange for a series of payments over 15 or 30 years. The size of those payments depends on the interest rate you pay. One day, a former student called me with a question. His parents had bought him a lottery ticket as a gift, and lightning struck. He'd won what the State Lottery Commission called $1 million. He didn't get the $1 million right away, though. He was actually going to get $50,000 a year for 20 years. He wanted to start a business now, and he was thinking about trading some of those future payments for cash now. A financial firm had offered him about $145,000 now if he promised to give them the four $50,000 payments he would get in years 2, 3, 4, 5. We were able to calculate the interest rate the company was charging him for the loan. It turned out to be a bit more than 9.5%. Do you own life insurance? When your insurance company calculated your insurance premium, it used the same time value of money ideas that we've been using. If you want to buy a policy that will pay your heirs $500,000 at the time of your death, the company has to figure out how much to charge you for that protection. The premium can't be too low or the insurance company will lose money on the deal. Can't be too high either because they'll lose your business. You'll buy a policy from some other company. The company takes its best guess of your lifespan, sets the rate of return it needs to be competitive in the marketplace, and calculates the size of the premium that produces that rate of return. Have you ever leased a car? You've probably noticed how the cost per month usually ends in 99. Maybe it's $199 or $299 per month. Advertisers want that first number to be as small as possible. $199 somehow sounds lots cheaper than $200. That's a pretty standard marketing technique. What's not standard is the amount due at signing. I've seen ads that say $4,816 due at signing. How did they come up with a number like that? Wouldn't you think they'd try to get it to end in 99 too? Well, sure they would, but the financial numbers usually don't work out that way. If we strip out extras like the cost of maintenance and insurance, then we can see that a 3-year lease is a lot like an agreement to sell you the car today and buy it back in 3 years for a predetermined price. The company leasing the car to you knows what the car's worth today, it knows about how much the car will be worth in 3 years, and it knows the size of the monthly payments, say $199. It can take those numbers along with the required rate of return it needs to make money on the deal to figure out how much has to be due at signing. Now you know something about the 3 things that determine your investment success: how much you invest, how much you earn, and how long you invest. Next, we'll take a closer look at why, no matter what you see and hear from investment advisors, it's almost impossible to find investments that promise high returns with little risk. Some people see that as the glass being half empty. I prefer to see it as being half full. Unless we make a big mistake, then we can be confident that we'll do just about as well as most everyone else.
Please subscribe and drop a like for new videos every day. Also go to BayStateProperty.com for tons of high quality finance tutorials just like this one.
Hi, this is Tracy from the 10-Minute Trader, and I'm going to show you what I use. This is what Thinkorswim should look like once you've logged on and it's downloading. Today is March 19th, 2012, and it is 8:18 in the morning. And this you don't really need, so you can log out. And so here's also what it should look like once it's done loading. And you're going to click over here on Market Watch. We're going to click on Dividend Alerts. We'll click on Refresh. And you're going to go from 10 trading days from now would be these ones. These are mine that I'm going to be using. Let's go over here. We're going to click on the blue dot of the first one. Click on Quick Chart. I don't really like this one. If you like it, you can trade, but I wouldn't. Click on Quick Chart for the next one. This one looks good. Recovering from a downfall, going up. Yeah, this one looks good. So we can click over here, and we're going to click on Trade. After this, we're going to take our trusty calculator, and we're going to divide 20,000 divided by the ask here, which is 84.87. And that is 235. I'm going to click on Buy Custom. I named this Banana Squares. I named this Banana Squares because it sticks out from everything else. And we're going to type in 325 here, and same up here. You have to make, very important that those two numbers stay the same. Click confirm and send. You're going to make sure it's right here, and then you're going to go send. And let's do another one. So click on trade, Market Watch. We're gonna look at these. I already did the top two. Click on Comcast. Comcast isn't very good, so I'm not gonna do that. This one looks good. So yeah, this one looks good. We can go with this one. We click up here on the blue dot again. We're gonna go over the trade. We're gonna multiply 20,000 divided by our trusty ask number here, 54.99. That's 363. I'm gonna go over here, Buy Custom, Banana Squares. And then we're going to click on confirm and send. And send. Now, I gotta go to school. It's 8:22. It did not take long at all. So, bye.